Imagine this. You've been doing everything right. Every paycheck, you automatically transfer money into your savings account like a responsible adult. You've cut back on takeout, skipped the fancy coffee a few times, and watched your balance slowly climb. But here's the uncomfortable truth. While you're patting yourself on the back for being disciplined, that money is quietly making you poorer every single day. Not because you're spending it recklessly, but because of how you're saving it. Today we're diving deep into the hidden ways traditional saving habits are actually sabotaging your financial future. And more importantly, what you need to do instead if you want to build real, lasting wealth in America today. Let me take you back a few years. I had a friend named Mike who was the poster child for responsible saving. He kept a solid emergency fund in his regular bank savings account, earning almost nothing, contributed just enough to his 401k to get the company match, and felt pretty good about his progress. Then inflation hit hard. Suddenly the same groceries that cost $100 were running him $130, rent went up, gas prices climbed, and Mike started to feel the squeeze. His savings balance looked fine on paper, but its actual power to buy the life he wanted was shrinking faster than he realized. This isn't just Mike's story. It's happening to millions of Americans right now who are stuck in outdated saving habits that worked for our parents' generation but are financial quicksand in today's economy. The biggest culprit is probably the one you're most familiar with, parking your money in traditional savings accounts that pay next to nothing. Right now, the average savings account in America yields around 0.4%. That means if you have $10,000 sitting there, you're earning a whopping $40 a year before taxes. Meanwhile, inflation has been running between 3 and 8% in recent years depending on the economic cycle. What does that mean in real terms? Your money is losing purchasing power every single month. That $10,000 might still say $10,000 on the statement, but next year it buys noticeably less food, gas, housing, and healthcare. You're not saving. You're slowly bleeding wealth while feeling responsible. Now contrast that with what the truly wealthy do. They understand that money must work harder than they do. High-yield savings accounts from online banks are currently offering 4 to 5% or more, which is a game changer for your emergency fund. But even that's not enough for the long term. The real wealth builder is understanding the power of investing over mere saving. When you invest in the stock market through low-cost index funds, you're participating in the growth of the American economy itself. Over the long run, the S&P 500 has returned around 10% annually, including dividends. That's not a guarantee, but it's a historically proven path that beats inflation by a mile. Think about the magic of compound interest, something Albert Einstein supposedly called the eighth wonder of the world. If you start investing early, your money starts earning money on its earnings. A 25-year-old who invests $500 a month at an average 8% return could have over $1 million by age 65. But if that same person waits until 45 to start, they'd need to invest more than double that amount monthly to reach the same goal. Time is truly the most valuable asset in building wealth, and every year you delay because you're just saving safely is costing you hundreds of thousands of dollars down the road. Another massive mistake I see all the time is ignoring tax-advantaged accounts like your 401k and IRA. So many people contribute just enough to get the employer match and stop there, leaving free money and massive tax benefits on the table. With a traditional 401k, your contributions reduce your taxable income right now, which means more money stays in your pocket instead of going to the IRS. The Roth IRA option lets your money grow completely tax-free, which is incredible for young people who expect to be in a higher tax bracket later. These aren't just accounts. They're powerful wealth acceleration tools that the government literally incentivizes you to use, yet most Americans aren't maximizing them. Let's talk about something even more insidious, the debt trap disguised as saving. How many times have you heard someone say they're saving up for a new car while still paying off their old one? Or keeping minimum payments on credit cards while trying to build a savings account? High-interest debt, especially credit cards averaging over 20% APR, is one of the fastest ways to destroy wealth. The interest you're paying the bank is far higher than anything your savings could possibly earn. Mathematically, paying off high-interest debt is often your best investment with guaranteed returns. Before you put another dollar into a low-yield savings account, make sure you're not simultaneously giving away 20% or more to credit card companies. Lifestyle inflation is another silent killer of savers. You get a raise or a bonus, and suddenly your car payment goes up, your apartment gets nicer, and your vacations become more extravagant. What feels like success is actually keeping you in the same financial position year after year. The people who build serious wealth maintain reasonable lifestyles even as their income grows. They redirect that extra money into investments rather than upgrading their standard of living. This is how the truly wealthy stay wealthy. They let their assets grow while keeping their liabilities in check. One of the most common mistakes, especially among younger professionals, is keeping too much cash sitting idle out of fear. Market crashes, recessions, and economic uncertainty make headlines every few years, and it's easy to get scared into thinking cash is king. But history shows that trying to time the market almost always backfires. The investors who make the most money are the ones who stay invested through the volatility. Dollar cost averaging, putting consistent amounts into the market regardless of price, has proven time and again to be an incredibly effective strategy for building wealth steadily over decades. Let's not forget about fees, those sneaky little charges that eat away at your returns like termites in your financial foundation. Many people are still paying 1% or more in management fees on mutual funds when they could be in low-cost index funds charging 0.03% or less. Over 30 years, that difference in fees can literally cost you hundreds of thousands of dollars. Always check the expense ratios on your investments. Shop around for better banking options. Question every fee you're paying because in the world of finance, every percentage point matters tremendously over time. Your credit score plays a bigger role in your saving strategy than you might realize too. A good FICO score opens doors to lower interest rates on mortgages, car loans, and even insurance premiums. Poor credit means you're paying more for everything, which makes saving and investing that much harder. Treat your credit like the valuable financial tool it is. Pay your bills on time, keep your credit utilization low, and monitor your reports regularly. It's not about being perfect. It's about being smart with the systems that affect every major purchase you'll make. The psychological side of all this is crucial too. Traditional saving feels safe and responsible, which is why it's so seductive, but real financial security comes from understanding risk in its proper context. Not investing at all because you're afraid of losing money is actually the riskiest move of all, because inflation will guaranteed erode your wealth. The stock market has always recovered from downturns throughout American history. The question isn't whether there will be crashes, there will be. The question is whether you'll stay the course and let time and compounding work in your favor. So what should you actually do starting this week? First, build or maintain a proper emergency fund of 3 to 6 months of expenses in a high-yield savings account where your money at least keeps pace with inflation. Then focus intensely on maxing out tax-advantaged accounts, especially if you have an employer match. Invest the rest in a simple, diversified portfolio of low-cost index funds. Automate everything so you never have to rely on willpower. Review your progress annually, but don't obsess over daily market movements. And most importantly, educate yourself continuously because the financial world is always evolving. Look, building wealth in America today isn't about being lucky or having a six-figure income from day one. It's about avoiding the common traps that make most savers poorer over time and instead making your money work as hard as you do. The difference between those who retire comfortably and those who struggle isn't usually how much they earn, it's how intelligently they save and invest what they have. Stop treating your savings account like a finish line. Start seeing it as the starting point for building real generational wealth. If you've been saving the old way, today is the day to make a change. Open that high-yield account, increase your 401k contribution, or finally invest that cash that's been sitting idle. Your future self will thank you, the compound interest will thank you, and your bank account, the one that actually reflects real purchasing power, will grow in ways you never thought possible. Thanks for watching. If you found this valuable, hit that like button, subscribe for more straight-talking financial advice, and drop a comment below telling me what saving mistake you've made in the past that you're now fixing. I'll see you in the next video where we'll break down exactly how to build a bulletproof investment portfolio even if you're starting from zero. Take care, and remember, the best time to start was yesterday. The second best time is right now.